We've seen gold spike up over $2,000 an ounce, which is primarily driven by concerns about the banking system, particularly in the US, and last week then developments in Switzerland. And this is going to be a conversation with Stephen Flood, CEO of GoldCore. I'm Dave Russell. This is GoldCore TV, helping you to make sense of the precious metals market so you can make better investment decisions. Steve, tell us what's going on in the gold market at the moment.
Well, there's been unprecedented demand over the last week from investors in the UK, the United States, Europe. We're seeing an awful lot of people opening up accounts. There is very legitimate questions about the safety of their banking deposits. Obviously, the regulators are scrambling to try to give assurances to the market that all is safe. Where possible, they are looking to have troubled banks acquired by stronger banks. And they are also injecting liquidity into the market. They are arranging for rescue finance and loans to be given to banks that are deemed to be in trouble. This obviously all came about from Signature Bank and SVB in San Francisco. The trouble that they had recently when there was a de facto run on their deposits by depositors. And when it was realized that the losses that these banks had endured was primarily as a result of long-dated securities held in the form of government securities had been marked down, and thereby losses given to the banks. And these losses had wiped out the bank's equity and put in danger deposits of their depositors, their customers. So there was a run on the banks. People are now quite worried about the banking system, and also they're questioning the ability of the regulators to quench any fire that has taken off. And they are questioning whether the regulators have the necessary firepower to, rescue these banks, whether they're systemically important, if they're going to let any fail, and basically where the losses will lie. So it seems that the regulators in the US and Switzerland have decided that the taxpayer or the industry via levies will pick up the tab and secure these institutions.
This is very much chickens kind of coming home for a roost, particularly for the Fed, because as you're saying there's securities held on the balance sheets of a lot of the banks as part of their liquidity. And these are the long-term bonds. They're held because they're highly liquid, and if there is a need for them to be liquidated to serve depositors, they are. But as a result, then they're held to maturity and not marked to market. And because we've seen the Fed aggressively increase rates over the last while, and what we've seen a significant sell-off and a reduction in the value of those bonds. So when they are forced to liquidate those, then they immediately effectively become mark to market, don't they? And they're getting massive write-downs. And this is kind of key to that issue. This is something that effectively the Fed has caused. So now they're caught between a rock and a hard place, effectively between increase in interest rates and their ability to fight inflation. And they seem to be, as you're suggesting, they're pushing now the impact of that onto taxpayers.
Yeah, I mean, ultimately you have a maturity mismatch. You have depositors who want to be able to call upon their deposits immediately, and you have the banks who are forced increasingly to put these large deposits with the bond market, with governments, and thereby financing governments' deficits. So the government wants their deficits financed, but they also want the banks to be liquid, and you can't have both. And when you have a change in interest rate policy and you rapidly increase interest rates, suddenly you put a huge amount of pressure on those banks who hold those assets, which start to depreciate in value very, very quickly. So interest rates go up, bonds go down, and thereby losses are incurred. And those investors are looking at those banks going, well, you don't have the equity anymore that you had. You own those losses. And then the regulator steps in and goes, well, we're going to make you all whole. We're going to back all these depositors. We're going to just magic the money and make it all go away. But they're not actually dealing with the original problem, and that is that there's a fundamental maturity issue with the way banks are structured and the way governments are financed. And now with interest rates rising, the tide is going out. We're finding out who is most exposed. And investors and depositors are asking these questions. They're like, oh, well, is my money safe? And the answer is no, not entirely. There are risks out there. The extent of those risks is being assessed right now.